Welcome back to Smart Stock Sam. There's big news on this stock recently, and market is reacting as expected. But let's slow down and focus on the facts and see how they are shaping the narrative. I'll cover what's real, what's noise, and what it could mean next. For quick updates like this, subscribe and tap the bell to catch every market move on time. Alright, here we go.
What if I told you it was possible for a company's contract backlog to explode by 180% in just 6 weeks? It sounds like a glitch in the market, but for Ondas Incorporated, ticker ONDS, it is the new reality. Today, we are answering the biggest question on every investor's mind. ONDS hits 180%. Is this the peak, or are we just seeing the launchpad for a massive analyst target? We aren't just looking at another speculative micro-cap drone company anymore. Ondas has just undergone a massive, structural identity shift, shedding its skin as a disparate holding company to become a unified, global defense and security platform. They've moved their headquarters to the heart of the Florida Defense Corridor for a reason. They are positioning themselves to be the operating system for the future of multi-domain autonomy. But here's the thing, while the headlines are screaming about their new $65 million backlog, there is a hidden metric regarding their capital structure that completely changes the risk profile of this stock. But to understand why this rebrand actually matters, we first have to look at how they're building their system of systems that the Department of Defense is starting to notice. For years, Ondas operated under a holding structure, essentially a collection of specialized assets. But that's gone. They've moved toward a single integrated operating entity known as OAS, or Ondas Autonomous Systems. Think of this as a 3-stage evolution. They took specialized, combat-proven assets like Iron Drone for the air, Roboteam for the ground, and Centrix for intelligence, and fused them into a single command point. This isn't just a name change, it's a strategic alignment designed to capture the entire defense and aerospace ecosystem. When a government or an airport authority wants a security solution, they don't want to buy 3 different platforms. They want one autonomous nervous system. Ondas is now that provider. Now, this structural shift looks great on a PowerPoint slide, but if we dig deeper into the actual numbers, the growth is even more aggressive than the marketing suggests. Look at this velocity. In November 2025, their backlog sat at a respectable $23 million. By the time the clock struck midnight on New Year's Eve, it hit $65.3 million. That is pure commercial validation. In Q3 alone, their revenue surged a staggering 582% year-over-year. This momentum was so strong that management actually did something you rarely see in this sector. They hiked their 2026 guidance by 25%, now targeting a massive $180 million in revenue. While these growth numbers look incredible, there is one hidden metric regarding their capital structure that we'll look at in a moment that changes the entire risk profile for anyone holding the stock. But first, we have to ask, where is all this new money actually coming from? It's coming from high-stakes defense and infrastructure contracts. We're talking about an $8.2 million repeat order to protect a major European international airport and $10 million in new orders for tactical ground robotics. They are even moving into combat-proven technology with an $11 million investment in Ukrainian battlefield tech. This isn't just about charity or testing, it's about real-world application in the most demanding environments on Earth. This has pushed their current sales pipeline to over $500 million, with a moonshot goal of hitting $1.5 billion in revenue by 2030. Now, usually, a company growing this fast is burning through cash at a dangerous rate, often leading to a death spiral of debt. But for Ondas, the script just flipped in a way that shocked the market. In a move that caught most analysts off guard, Ondas just neutralized its solvency risk. They have over $1.5 billion in pro forma cash against a tiny $18 million in debt. Let that sink in. Based on their current burn rate, analysts estimate they have a 367-month runway. Essentially, the question of will they survive that plagues most small-cap tech stocks has been replaced by how fast can they execute. This cash position gives them the ultimate war chest to acquire competitors and scale their manufacturing without needing to beg a bank for a loan. However, none of this matters if we don't look at the massive catch buried in the fine print of that cash raise. This is the bear case that every investor needs to understand before they decide if this is truly the peak. Here is the bear case, that $1.5 billion in cash didn't come for free. Current and future investors are facing unprecedented dilution. There are over 121 million warrants looming overhead that could flood the market if the stock hits certain price targets, specifically the $28 mark. On top of that, they've just switched auditors to be DOUSA after previous reports contained going concern language. While BDO is a top-tier firm, an auditor switch during a massive rebranding can be a yellow flag for some institutional investors. They are also absorbing 3 companies simultaneously. If they stumble on the integration of these teams, those big airport contracts could vanish. So, with all that growth balanced against heavy dilution, what is this stock actually worth today? The valuation is a total tug of war. On one hand, the stock is technically expensive, trading at a price to book of 10.9 times, that is nearly 5 times the industry average. A conservative model based purely on current assets puts the fair value at roughly $12.76. But if you buy into the growth-adjusted model, the one that accounts for that $1.5 billion revenue goal, the intrinsic value jumps all the way to $33.35. Wall Street is leaning toward the bullish side of that gap, with H.C. Wainwright leading the pack with a $25 price target. So, what is the final verdict for you as an investor? The verdict is clear. ONDS is a high-momentum defense play with a near-perfect Benzinga edge score of 99.6. The trade-off is simple. You are accepting significant dilution today for the chance to own a $1.5 billion revenue platform by 2030. The safety of this company is now officially in the cash, but the alpha is entirely in the execution. This is one for the watch list if you believe the future of defense is autonomous, but you have to be comfortable with the volatility that comes with those 121 million warrants. I want to hear from you. Do you believe Ondas can actually hit that $1.5 billion revenue goal by 2030, or is the dilution from those warrants too much for you to handle? Let me know your price targets in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more deep dives into the stocks shaping the future of defense tech.
Alright, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.